Austin's apartment market stats went from great to good in 2014 due to a really big block of new supply hitting in the past year. So what lies in the immediate future for the Texas state capital? We're going to explore that in today's edition of Apartment Market Dynamics from NPF Research. I'm Jay Parsons, he's Greg Willett, and this is the third in our four-part series examining the four big Texas apartment markets. And in particular, we're looking at the potential impact to the apartment markets from the downsizing energy sector. And so let's start off with that question. Is the drop in energy prices a big deal for Austin?
As we said in the North Texas video, there is really no direct energy employment in Austin, so that's not a big deal. But I'm going to refer back to something you said right in the intro. Austin is the state capital of Texas. So that means that you do have a big state government segment, and obviously funding for that segment is to some degree related to the tax revenues that you generate out in the oil patch, and those will be coming down. Now, that's really all in theory. In reality, here in Texas, and we are here in Texas, the two of us, state government doesn't tap into those energy revenues on a routine basis. Most of that money goes into a rainy day fund that you can turn to when times are bad. So even if you had a little bit of a short-term shortfall on the revenue side, you could cover that very easily if the legislature chose to do that. Now, then let me focus on that if the legislature chose to do that part of that statement. It is interesting that we have a whole new crew in charge in Texas by and large. For the first time in more than a decade, we have a new governor and a new lieutenant governor helping to shape the agenda there. We have a certainly Republican-dominated state legislature that has even moved even farther in that direction, and that does include more Tea Party people. And these are folks who are fiscally conservative, let's phrase it that way. They think that spending cuts are a good idea regardless of the revenue environment. So certainly we could have some spending cuts that emerge, although for me personally, my opinion is that reflects the decision makers more than it would anything in the revenue numbers. Having said all that, our expectation is that Austin will add 32,000 jobs in 2015. That's really pretty much in line with 2014's additions, which totaled 29,000 jobs, or 3.2% expansion.
And Greg, thanks for taking the hard part, the political talk, and I'll go to the easy stuff. Here are the apartment stats. In 2014, Austin built 12,115 units, and that is a record block of supply. Inventory growth of 6.1%. Nationally, only Austin and Raleigh-Durham expanded at such an aggressive pace. And the good news is that demand was also very strong at 8,868 units, a big number. But the bad news is it didn't keep up with deliveries. So occupancy dropped down to 120 basis points. Now, the good news there is that the previous performance was robust, so that the resulting Q4 2014 occupancy figure was still good, 94.6% even after that drop. The Metro's rent growth performance mirrored the pattern seen for occupancy, slowing meaningfully, but still some really good numbers. Effective rents for new leases climbed 3.6%. Rent growth remained strong at 4.8% for middle market Class B product. A slowdown to rent growth around 2% wasn't especially surprising in the Class A niche, given that so many properties are moving through initial lease up. Maybe more surprising is that rent growth also cooled around 2% in the Class C segment.
And Jay, certainly as the construction number was probably the one that really moved everything in 2014, that's going to be true in 2015 as well. So the question is, does that big new supply continue? And sizable new supply continues, but we are actually moving past the peak. Currently under construction in Austin right now, we have 13,443 units underway. Of those, 9,755 are in projects that should complete in 2015. So the coming year's targeted deliveries actually dropped notably, about 20% from the 2014 volume. Unlike in Houston or DFW, which we've talked about, where it's very urban core focused, very high-end, expensive product, the new supply on the way in Austin is more spread out. And we like that factor, and we do think that that's going to actually help the absorption pace. So we're pretty confident in this one as we move ahead.
Yeah, so in terms of the outlook, with still some good job growth forecasted, with supply at least somewhat dropping down, and with that supply also being more spread out, we're forecasting that Austin's revenue growth numbers should actually come in a little bit better than what we saw in 2014. We expect to see occupancy bump up about 30 basis points, and for rent growth to accelerate mildly to 3.9%.
And it is encouraging to hear one where we actually think that 2015 is going to beat the 2014 number, even if it's just by a small margin.
And it does show, too, the influence that new supply could have on the expectations. And we're going to be talking about that again in our next video. We talk about San Antonio as we wrap up our 4-part series in the Texas markets. So until then, for Greg Willett, I'm Jay Parsons. Thank you for watching Apartment Market Dynamics from NPF Research.
Want more? Go deeper with NPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, NPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.